Good evening, everyone, and thank you for joining us. It's always tricky to be the panel towards the end of the day because the room starts emptying out and you have the burden of wanting to keep everything interesting so you can draw people back in. So we'll try to do that today, and we have a very interesting topic, sustainable foundations, financing India's climate and infrastructure goals. India is at a very crucial crossroads. As the country wants to be a $10 trillion economy, a Viksit Bharat and Atmanirbhar Bharat, India also needs to make its way to being a net zero economy. And those two goals are conflicting goals and have been conflicting goals for several decades. For several decades, GDP per capita has been directly correlated to energy per capita. And so it's almost impossible to keep growing at the rate at which the country is growing and at the same time achieve our net zero targets, which is what makes the climate conversation extremely pertinent and extremely important. We need all sorts of players to come together, the entire ecosystem to come together and commit to these important goals. And we are seeing that happen. We are seeing about 25 billion was raised towards clean energy in 2024 alone. About 2 billion of that was raised by independent power producers. And we're seeing that a lot of investors that put in money are already beginning to see exits, are already beginning to see monetization. We saw 10 major clean energy and e-mobility companies get listed in the last 12 to 18 months. And these are outcomes to be celebrated. And the data continues to be strong across the board. Even if I'll share some data with you on 2025 Q1 to Q2. Q2 saw about $3.5 billion being invested across 355 deals. And compared to Q1 2025, that was a 25% increase, but fewer deals, which signals larger capital deployment to later stage assets. And later stage project finance, infrastructure deployment has been where most of the capital has steered. But we're seeing overall deal volumes continue to be healthy. This is an emerging and important sector where both focused VC funds and PE funds are coming into creation, but also generalist fund investors are diverting capital. With me is a very strong panel, so please welcome them all. And let's start by getting each one to tell us about their backgrounds, what they're building, and share some specifics of their work, and then go into the later part of this discussion. Akshay, can we start with you?
Good evening, everybody, and thank you so much to IVCA for organizing this event and this panel. I represent the NEEV funds, which are private equity funds managed by SBI Ventures, which is the GP arm of State Bank of India. The NEEV funds are climate-oriented funds investing in early growth and SME businesses, specifically in climate and sustainability. We've fully invested from Fund 1, almost fully invested from Fund 2, and are currently in the process of raising Fund 3 with a focus on climate tech investing. Thanks, and great to be here.
Thank you.
Amit?
Yeah, good evening, everyone. Hello. Yeah. I'm Amit Jain, CEO Real Assets Kotak Alternate. I've been with Kotak Group for 21 years. I've been fortunate to see the entire infrastructure and sustainable finance journey for India till date. I currently manage two funds, Performing Credit Fund and Kotak Yield and Growth Fund. We are also in the process of raising another fund, which is Energy Transition Fund, primarily dedicated for the purpose that we are talking today. I'm happy to be here. Thank you.
Arvind?
Thank you to the organizers. Thank you for introducing me and calling me on this panel. I'm Arvind Anantnarayanan. I am one of the fund managers of the ValueQuest TriStar Fund. It's a part of the ValueQuest group. This is the third in the private equity funds, the first being the Scale Fund, which has been fully deployed almost, and Scale 2 is its successor. Both of those are sector agnostic. TriStar, on the other hand, is a 2,000 crore fund. It focuses on areas related to manufacturing, aerospace, defense, energy transition as well, particularly manufacturing-linked ideas in that, precision engineering and other niche ideas in manufacturing. These are the sectors that we are looking at. And it's a pleasure to be a part of this because energy transition has been an important philosophy across Value Quest over the last few years, and it's something very important to India and the world as a whole. Thank you.
Nakul.
Hi, my name is Nakul Zaveri. I'm a partner at Leapfrog Investments. We're a global private equity emerging markets investor. We invest across financial services, healthcare, and climate, and I globally co-lead the climate solutions.
Thank you, Nakul.
Hi, I am Saurabh Singhal. I manage the infrastructure and real assets at Neo Asset Management. We are an operating assets buyout private equity fund. We have closed one fund, 2,300 crores equity, and we are in the middle of raising the next fund, which is going to be a 5,000 crores equity capital.
Thank you. And I'll also quickly introduce myself. Richard, I run Green Marble, and Green Marble does early stage investments in engineering innovations for energy, materials, manufacturing decarb, agri-tech and health tech, which are all sectors that cut across climate mitigation, resilience and adaptation. Since you saw from the backgrounds that we're cutting across various stages of capital, across from early stage growth all the way to late stage, and we talked about some of the recent data which is showing a lot of capital going towards the later stages. Let's start there. Renewable energy clearly has gotten a lot of capital. Over $3 billion got promised to the MNRE in the most recent budget announcement. That's a 39% increase from the last estimate we had last year. Let's start by talking about some of the successes that India has had in the renewable energy space and how that could then translate and learnings from there could move to other sectors. I'll call upon you, Amit, and maybe Arvind, you as well, since you both do later stages, to talk about learnings and cross-pollination from renewable to other sectors. Amit, you go first and Arvind can add.
Sure, thank you. I think what has happened in renewable energy is actually phenomenal. I still remember 2012 when we did 1 gigawatt a year, and we said, wow. Then we came to 2017, we were doing about 1 gigawatt a month, and we said, wow, again. Come 2024, we were doing 1 gigawatt every fortnight. And as we speak today, we're doing 1 gigawatt every week. That's the kind of growth we have seen in terms of solar and wind capacity addition in this country today. It has not happened without policy support, etc. And I think some of these things that happened really, which triggered this kind of growth, has been one, the counterparty risk. In any kind of business where foreign investors or banks, etc., they have to lend money, the counterparty risk has to be really taken care of. The government very nicely moved the state discom risk by getting all these contracts through central agencies like SECI, NTPC, SGVN, etc. So that gave a lot of comfort to bankers and foreign investors. And we are looking at bankers who were earlier funding projects for 12 years, moved to 15, and then 18 and 22 years, primarily because they brought a lot of comfort from counterparties. Second was transmission infrastructure. And the government invested rightly, not only on the state transmission infrastructure, but also ISTS connectivity, where power, which is produced primarily solar power in 8-9 key states in India, can be transmitted to across the country. That is something very unique. Just to share, even US doesn't have that kind of transmission capacity where one power produced in one corner can be transmitted to another sector. The third part was tariff. If you look at why renewable energy really became successful, because we have become one of the cheapest sources of solar power across the industry. Yeah? So we are looking at solar tariff at 2.5 rupees, which is much cheaper than any other source of power. And trust me, for any infrastructure growth sector, India is a very cost-sensitive market. So unless you can take care of tariffs, the growth cannot happen the way it has happened. And fourth, and most important part is exits. We have seen very successful exits, either in the form through InvITs, which is now having a 7 lakh crore AM. So that exit provides capital to developers to grow faster rates. And we had a lot of successful IPOs as well, whether it's a developer like NTPC Green, Tata Power, etc., or we had module manufacturers such as Wari, Premier Energy, etc. So these things are very rightly put across with government support, took the entire industry into the right direction, and we can exactly replicate, in which government is now trying to do same thing in e-mobility space, where the central counterparties are giving payment guarantee to make the sector much more viable, and similarly green hydrogen. I think India has done really well on renewable. It's right time to accelerate for other segments like e-mobility or green hydrogen.
Thanks, Amit. Just to take off from what Amit was just saying, and if you were to visualize the entire spectrum of climate interventions, right, and just to sort of visualize a continuum, on the left-hand side, you will find very early stage companies which are focused on technology and extremely disruptive business models. As you progress towards the right, you can visualize where technology has become an infrastructure play, and it's gone to a cost of capital game, right? It becomes the lower the cost of capital, the higher your returns are effectively. That's what the progressive, that's exactly what the progressive sort of spectrum on climate is. And somewhere in between you have early growth, and that's the focus that we have at NEEF Funds, early growth stage companies where you establish proof of concept, you established a product market fit, you need capital to scale up, you have a very, very strong policy support, you have government initiatives like Amit also mentioned and the previous panel also mentioned in the mobility space, very, very strong ecosystem approach to developing the sector put in place by government. We're seeing that across different sectors. We're seeing that in mobility, we're seeing that in agriculture, we're seeing that in green hydrogen, we're seeing that in energy efficiency. Across the climate spectrum, we're seeing government take very, very proactive policy decisions, which is then translating into the entire ecosystem getting built. That to us allows companies in the growth stage expand and get to a stage where it becomes an infrastructure-like story, where Amit and Saurabh can then come in and offer different pieces of capital and potentially exits to the early stage investors as well.
Thank you, Akshay. I'd love to bring in Arvind and Saurabh and then Nakul subsequently because he fixes the missing middle. Arvind, what are your thoughts on the whole infrastructure growth beyond renewables? What are the sectors of opportunity and where are you operating? Any thoughts on that?
Thank you. First, I'll agree with the two gentlemen on the side. I'll tell them it's very clear that renewable energies is an idea whose time has come. There never has been a form of energy as cheap as solar and as readily available in geographies where it has been. And now it is India's time to create an entire infrastructure bouquet around this. It's not just solar. Going back from there, other infrastructure also would be created, including hydrogen, batteries, and grid robustness, which would make the story substantially more, let's say, potent going forward.
Thank you. And Saurabh, what are your thoughts on that?
Listen, I look at infrastructure from an asset standpoint, right? Slightly different from a venture capital, which will look at a company, right? And we should look at growth from a company standpoint. I look at infrastructure as an asset. And when I look at infrastructure as an asset, I divide it into three parts from a life cycle standpoint, right? And look at financing of these three parts differently. And the world over, we have seen these three phases of infrastructure development. The first part being the very critical, where the infrastructure is created, right? Where it's developed, constructed. The second part, which is an interesting part, which is coming up in India now, and which is where I'm very focused on, is the stabilization of infrastructure, right? A large solar plant, a large toll asset, a large battery asset, etc., getting accumulated and stabilized for a small period of time, 3 to 4 years. And then there is a pure operational part of infrastructure asset, which is basically just keeping the lights on, right? So if I look at these three aspects, then I look at funding the middle tier, which is where the accumulation is happening, and funding or financing of the last tier, which is where in India there are InvITs and there are yield cos in the US and so on and so forth. That's the most critical part. Because if that part is taken care of, and which is where the government is focused on now, and I'm very glad, if that part is taken care of, then the capital available in that will free the capital that I am putting in the middle tier, and then I will free the capital that is available for developers to reinvest, which is where I think some of my other panel members are also working in. So I think this, if I look at infrastructure from these three aspects, then to my mind, the last piece is where we need a very stable, long-term, predictable policy framework.
No, clearly. So it's a continuum, and every part of the continuum needs to deliver returns for the one before that to attract capital and so on and so forth. And this is a sector which is evolving, and it has its unique characteristics because we didn't see these continuums when you were looking at an e-commerce play or when you were looking at a SaaS play. There was a sort of singular linear growth trajectory. But the profile of the asset evolves in the climate tech space as it goes from early to middle and later stages. And here I'd like to bring Nakul in. Nakul, you and I were talking about the missing middle and then spotting these assets on time so that you can get in there and support that stabilization layer, as Saurabh calls it.
Thank you, Ruchira. I think I'm going to take a step back and try and give some perspective on the size of the market that we're dealing with. I think the oil and gas industry globally is about $6 to $7 trillion. The pharmaceutical industry is, let's say, $1.5 trillion. Semiconductor industry is about $800 billion. The EV ecosystem is $1.5 trillion. I'm putting that in perspective. $1 trillion goes into renewable energy globally every year. So we're not talking about industries that are sitting on the periphery anymore. We're talking about industries that are mainstream, right? 30 years ago, these industries didn't exist in the form they exist now. We've got a tail end of industry business models that are slowly evolving, right? Batteries or green hydrogen that is evolving. Some of these will take time, some of these will accelerate faster, some of these will get slower. What we are seeing now is mainstream, or how it was pronounced, generalist investors or non-thematic investors are thinking about how to participate in the energy transition story. If you talk about AI, the backbone of AI is energy, again, right? I was talking about strategic autonomy. Energy is a very categorically important element there. However, I think as Akshay mentioned earlier, for emerging markets particularly, we cannot be having what we call a green premium to scale up. We need to see affordable and accessible business models. And therefore, green discount becomes critical. And what, as we call ourselves growth investors, we want to make sure that we support and invest in finance in business models that are scaling up beyond product market fit, are now able to deliver unit economics, are able to sustain the stage 1 and 2. How do we support them with growth capital so that they are able to go and either break out and tap capital markets or break out and go for large infrastructure capital? And I think the time for certainly some business models is already here.
Absolutely, and I loved how you talked about these industries being created and becoming mainstream. And I think all of that, especially when you look at the EV ecosystem, I think it took less than a decade for all of that to happen in India. And we're going to see more of that for hydrogen. We're going to see that for battery cells. We'll see that for electrolyzers. We'll see it for new and more energy efficient motors. Because all this infrastructure deployment requires plug-in technologies. And currently, India is getting up the curve on domestic value capture, but still highly import dependent. And so there's a very strong imperative to do research, push for research and innovation domestically, and have product iterations and world-class products produced in India. I absolutely agree with you. There's no scope for any kind of green premium in the country. There has to be a green discount. There has to be products that work better than global parallels, and they work at a better cost structure and price point for the country. So Akshay, I'll move back to you for the innovative bit, because you look at the early growth, and you've done investments in hydrogen, you've done investments in the water space under the NEEF fund. What kind of innovations are you seeing in these spaces that you think have the potential to grow to scale?
Sure. I think, Ruchira, it's important to recognize that climate investing is a mix of hardware as well. Climate tech investing is a mix of hardware as well as the software part of it, right? It's not like potentially, say, a consumer business which was largely, or a SaaS business which was largely software driven. It's going to be a mix of physical infrastructure, hardware, married with the software infrastructure. And therefore, you're seeing innovation across both the hardware as well as the software pieces. We've seen robotics, we've seen AI, we've invested into a water tech company, which essentially manufactures a bot that goes into the pipelines to check for pilferage, to check for blockage, pilferage, theft, so on and so forth, to do condition assessment. We've seen companies which use AI in marrying, and the green hydrogen company that we've invested into uses AI to marry the renewable energy with the gas generation requirement and to do predictive gas generation. So we're seeing very, very innovative business models where AI and deep tech, the flavor of the day, deep tech is actually being used to marry physical infrastructure as well as the requirement.
Absolutely, and I think those innovations are solving tough problems, and they are being created in India at the Indian cost structure, and so the frugal economy is playing out, right? And because of that, I think they also stand to win globally. I'll move further on innovations, not just in product, but also innovation in the forms of financing. So to the late stage guys, because a lot of the infrastructure financing requires not just equity, it requires debt and sometimes quasi debt and equity structures. What kind of innovative financing models are you seeing? Amit, you can go first and maybe Arvind after.
I think India as a country is largely capital deficit. And we look at not only the internal resources, but also the overseas marketplace. And it's very important that we attract overseas capital because that's where a lot of structuring possibilities come from. When I go and talk to investors across US, Europe, other parts of the country, the world, what we really see is that they see India as a significant opportunity outside of China with respect to renewable power and other such segments. Just to give you a context, what they love about, India. India has got about 18% of population, and our power consumption is only 6%. While if I look at China, similar kind of population, their power consumption share across the globe is about 33%. So I'm not saying India is moving from 6% to 33%, but it will settle somewhere in between. So from a sustainable energy demand perspective, they see India as a good opportunity. Two, something which was really stopping them from coming to India was policy stability, and two, size. Is the opportunity size big enough or not? Because all these innovative financing ideas need scale. What has India demonstrated really well with respect to scale? One side of development we spoke about in my early part of discussion. Let me give you another color here. Outside of China, India is the largest renewable power producer in the world today. What India has rightly done in terms of amount of capex that we are doing, we're looking at close to about $150 billion of capex over the next 5 years in the infrastructure space. That's a huge opportunity in India. And the next question comes, the numbers look very big. Has India really done something like this? Now let me give you a perspective of that lot of thoughts which were there, and there is so much of China dependency. Let me take an example of renewable energy itself. We were so much dependent on modules for solar power, and all these modules were getting imported from China. Just to give you a context, 5 years ago, India's solar module capacity was 15 gigawatt. Today, it is 150 gigawatt plus. The solar cell capacity 5 years ago was about 3 gigawatt. Today, it is 30 gigawatt plus, so 10x. So scale is no longer a problem which India can't solve. So these overseas investors are looking at India very, very favorably. What they're really looking at is how do we get to participate in multiple structures in India, whether it is, let's say, subline financing, or should we say blended finance? Are they okay to look at platform level investments? Answer is yes. What they're really looking at from a concern perspective, which I must address, one, from a return perspective, they want Indian returns because of the currency depreciation to be better. So one thing we have to resolve is how do we look at stable currency? And if we are not able to address that issue, can we give some hedging mechanism to these investors which reduces their cost? Two, from a return perspective, as the returns in US market, etc. have been very good, they are looking at 18-20% plus kind of return when they invest in infra space in India. The biddings have been very, very aggressive, which has resulted into some of these project returns coming down. Now, the only way to solve is, on one end, we want cheaper financing, On other hand, the investors are looking at better return. Now, how do we marry the two? Now, we can only marry the two by doing two things. One, the government starts supporting the cheaper sources of funding. So if they can come as a senior instrument and provide cheaper sources of funding, that can improve the return for investors. And two, they can reduce the risk. And government has done a phenomenal job by now announcing under construction project risk guarantees. So NAFID is working with the government that how can they improve the under construction risk which can be transferred to government, and then it becomes risk adjusted basis much more favorable for overseas investors. And I must say that while they are doing this to attract more overseas investors, the domestic institutions have still not really entered infrastructure in big way. So all our pension funds, insurance, etc.
But that's changing.
Are looking at investing in India.
Yes, that is absolutely changing.
It's a big opportunity, and I think India is ticking the right boxes.
Perfect.
Can I add something to that?
Jump
I
in.
think, to my mind, the biggest innovation in financing that I've seen in India, and I started my career like 22 years back in the US, where when I first started working, I looked at something called REITs, right? So, and I came to know that in the US in 2004, there was something like REITs. And obviously, we had never heard of it. And now, if I look at the innovation that is happening on the far side of infrastructure financing spectrum, that is where the value lies, right? If we can have investors, retail investors come in, and they are very interested, by the way, right? I mean, when I'm talking to my investors, before I talk to them about my fund, they talk to me about InvITs, right? And asking me, which InvIT should I invest? So I think there is a lot of traction in the retail investors to go into the InvITs and REIT side. And their cost of capital ultimately needs to come down to 9.5%, 10.5%. If that happens, and we have a large-scale participation in InvITs and REITs on the far side, then automatically that will translate into the developers, the cost of capital, and most importantly, the cost of creation of infrastructure. Today, our cost of creation of infrastructure is very high because the return expectations are 25%. And developers, by the way, are making 25% equity IRR on their projects, right? But if this happens here, then I think this will percolate.
Absolutely. It opens up a new pocket of capital. And the more pools of capital, more diverse pools of capital we bring together, the more overall capital will come in and more risk hedged it will all be, because each pool is looking for somebody else to be alongside them. Arvind, any thoughts from you?
I would just like to say that renewable energy is currently, and of course, most of our investors are from the Indian side, and even on the side of those investors, there is substantial interest in renewable energies now. Part of this is because of the wonderful exits that someone spoke about, Wari, then Jupiter, all of these, they have created a lot of interest.
Real proof points, yeah.
And from my perspective, I generally prefer to look at the picks and shovels of this energy transition, usually the cap goods, the manufacturing side, as I mentioned about the fund. So under those circumstances, even for them, there is substantial quality of return. And those businesses, because they're catering to a lot of these infrastructure providers who are in turn enjoying a good environment from the government, investors are much more buoyed and comfortable in investing in these assets. And one last point I would say, again, in praise to our government, just to add here, because of these new structures which have come up, it is very much possible that at least in renewable energies, the issues that happened with the coal energy sector and the infrastructure associated with it has rather skillfully been stepped aside.
Absolutely. And on that note of creating new structures, of course, no conversation on climate is complete without talking about blending different forms of capital. In a way, that's already happening, right? Where at the project level, you can bring different pools of capital. We talked about bringing different diverse investor types. But Nakul, your thoughts on blending capital for the growth equity phase where you participate?
Around blended finance? Yeah. I have a slightly different view. I call it the illusion of blended finance. It's not that simple. Blended finance coming from different pools of capital, different allocators have a different cost structure to it. Cost is in terms, not only in terms of dollars, but cost in terms of time, compliance, fast pace of investment that is required in the Indian context or the emerging market context. So blended finance is evolving. There are certain structures which could be called blended finance early on. For example, first loss. First loss is a structure that is very well accepted, understood in our ecosystem, appreciated by banks. But as soon as you start climbing that capital stack and start putting in blended plays in different elements, this is still to be understood well by who can absorb the cost of blended finance. I think technically it does brilliant things to return. If absorbed well, return enhancement can take place, mitigating risk can happen, but we believe that there is a significant amount of learning that is still anticipated.
Absolutely. I think there's still early days for true blended finance to happen. I'm glad that at least there's enough conversation around it, because if you see any change, there's a lot of good dialogue always precedes action. So I'm glad that we keep talking about blended finance. I think we're still scratching the surface when it comes to the potential of true blended finance and what it can do for the climate space. We have about 9 minutes left, and I know we're running late overall on the agenda for the day, so I don't want to overrun. I think last thoughts from all our panelists, I'll focus on the positive side. If you guys can share one case study or one example of what's really worked well in your funds. If you're comfortable, name the asset or the founder, but if not, just the space that has worked for you and delivered good outcomes. Akshay, from you, and then we'll go this way.
Ruchira, you're putting us in a bit of a spot. I would say that all our portfolio companies are doing well and deserve to be mentioned. But given you asked me to pick one, I'd pick a company in the biofuel space. When we invested, they were at about 35 crore revenue. Last year, they closed at about 1,000 crore revenue. They've got tie-ups with almost all the oil marketing companies in the country, and they're setting up biofuel plants, the technology as well as the EPC services for biofuel, for the biofuel sector at a very, very rapid pace. Yeah.
Thank you. Amit?
Yeah, thank you. I'm not naming the company. It will go for listing soon. So it's a company which we started right from day one, and it was in the CNI platform. While the country was growing on the utility side, this player decided to grow the CNI space. And trust me, India looks like one country, but actually it's different states have different CNI policies. And we've really supported this company right from, talking about policies on each and every state, which was very different. But I'm so happy in the last 7 to 8 years, we have seen the CNI market growing so well that today you can create a CNI platform at scale. And we are not talking about megawatts, we are talking about multiple gigawatts. So the policy levels are much more standardized today. Two, what has beautifully played a role here, that this player today, not only creating CNI capacities, it has also got into battery storage. Two, it has also got into module manufacturing, etc. So today, a player with the support of banks, there are private equity investors, there are large overseas investors on the DFI side who have invested in this company. So that's something that we feel very proud of, that we could support a company on the CNI space, which today is one of the leading players in the country. So.
Thank you. Arvind?
In the renewable energy space, of course, I will not name the company, but there are hints of it adequately. This is one of the largest. It started off as a module manufacturer and then is backward integrated very successfully. It has been one of the large success stories which has come out in the post-COVID period. We have to be honest and say that COVID also gave us an opportunity of entry and circumstances of entry which are unlikely to be replicated. Nevertheless, kudos to the management to be able to backward integrate to that extent, be on the right side of policies, and not stop at being a renewable energy, solar-only story, but also move further back, almost replicating what the Chinese are doing, basically Longis of the world. They are all now trying to become integrated energy solution providers. This entity is doing the same. They also have EPC, they have battery storage and hydrogen. So that is a wonderful success story, and all success and great luck to that promoter and that company going forward.
Thank you.
We're excited about a company which is into pay-as-you-go solar distribution. These are at low-income emerging consumers, embeds financing into it looks at very simple household solar products, including energy as a service in sub-Saharan Africa. Fairly large companies, when I talk about the size, is between $300 to $400 million in terms of revenue. So we are seeing some of these category-defining companies coming out of geographies that still have to define some basic infrastructure aspects as well.
Thank you.
Well, thank you for asking that question. I'm very proud of this company that I acquired. It's called Solar Arise. It's a platform of 450 megawatts, basically. And when I acquired it with an expectation of 20% IRR. See, we are not a venture capital fund, right? So, we acquire stable, and we like stable operating assets. And now I'm very happy that over the 7-month period that we have taken the asset under our control, we're now tracking 27% IRR on that platform. So it's a great platform that we acquired at a phenomenal price, and we have done some great job on improving the asset itself. So yeah, I'm very proud of it. Thank you.
So
wonderful. And
as a coincidence, when we incubated 2 platforms, so Solarize was also incubated by Kotak Alternate. We were the initial investors, along with the CNI platform. So our utility story, thanks that it is giving you good IRR. We made good IRRs too.
Thank you, Amit.
Great to hear that. And actually, these examples are particularly pertinent because what it tells you is there are stories of stable platforms where you expected only a 20% and you're getting more and you get, and there are stories of new and emerging products, new and emerging categories where new sectors will be defining. So this climate is a space that's allowing the new and the old to coexist and for all collectively to deliver returns. So it's super exciting, and I think it requires all stakeholders to come together. The journey has only just begun. We need many more founders, many more investors, and the government stakeholders to keep pushing in the same direction. India's journey to net zero will be very relevant, not just for India as it solves for itself, but also for the world. Because once we have the green discounts, imagine what we can do when we start delivering these products world over. So thank you guys, and thank you to IVCA for giving us a chance to discuss this extremely important topic. And we are just in time. Maybe we have time for one question? Do we? 3 minutes as per that clock there. Okay. One question from the audience. No? I think we were very clear. Thank you, guys. Oh, there was one. There's one. Yes.
Hi, I just wanted you to elaborate a bit more on the use of AI in the field of renewable energy. You were telling something about how AI is being used to forecast the energy demands.
Yeah, so essentially what our company does is predicts when the sunshine is at the maximum possible for it to use solar power to run the electrolysis to split water into hydrogen and oxygen to then generate green hydrogen, which then gets used in the sold to the customer. Essentially, it does predictive analysis of the lux factor to figure out when the solar plant can run at its optimal usage.
Interesting, really interesting. Thanks.
Thank you all.
Thank you.
Thank
Thank
you.
you.